When will Toyota be cheap enough? I want to introduce you to the Toyota team in the Valuation Masterclass Bootcamp number 20. We had 8 people who graduated in this team. 4 of them you can see right there. So I thought I would go through their work. But before I do, what is the Valuation Masterclass Bootcamp? Well, we've had 1,000 attendees so far, 600 graduates. Graduates say they spent about 150 hours over 6 intense weeks. So let's talk about Valuation Masterclass Bootcamp number 20 that just finished just last week. We had 63 attendees and 35 graduates. The rest of them didn't make it, unfortunately. We had 29% female and 71% male. Of the ones who declared their occupation, 12 were students and recent grads, 4 were finance professionals, 2 accountants, 2 consultants, and 2 engineers. Let's look at Toyota, the company that they did, and I'm going to look at their work and try to give some critiques and some ideas. Of course, it was founded many years ago. After a near collapse in the 1950s, it created the Toyota production system, now a global manufacturing benchmark. In fact, they launched an effort to improve quality in 1961, which led them to win the Deming Prize in 1965. The 70s oil crisis had boosted demand for Toyota's fuel-efficient cars and drove global expansion, though Toyota really didn't make waves in the U.S. until the 80s and into the 90s. They launched the Lexus brand, which is a luxury brand, in 1989. And in 2024, Toyota led global auto sales for 5 consecutive years with 10.8 million vehicles in 72 factories across the world. Incredible. Toyota pioneered hybrids with its Prius, launched in 1997, and hydrogen with the Mirai that they launched in 2014. Now they're investing in BEVs, solid-state batteries, autonomous tech, and woven city. So there's 4 points that my students talked about that I went through in a little bit more detail to think about. The first is hybrids drive profits and fund Toyota's EV transition. Toyota leads global sales and shows supply chain strength. And EV expansion targets 1 million BEVs by 2027. And China remains a strategic despite its recent dip in the sales in China. So let's look into the hybrids here. 3.5 million hybrids were sold in 2024 with a strong 14% operating margin. That's just incredibly high margin. Hybrids are the core profit engine, funding EV and electric vehicle and battery investment. And $3.6 billion EV plan aims for 1 million BEVs by 2027, or roughly 10% of revenue. Now, Toyota's gotten a lot of pressure over the years for not being pure EV, as many companies have committed to. But many companies, whether it's the Western automakers in particular, that really hurt themselves badly by going after the EV kind of blindly. And now they've pulled back from that. So Toyota's pursuing the solid-state battery R&D that they're funding by hybrid profits. And their objective is to get that up and running by 2027, which would be longer lasting and much faster charging. Of course, there's a lot of technical hiccups that they got to get through. Now, number 2, Toyota's leads global sales and also has an amazing supply chain. Toyota ranked number 1 in 2024, selling 10.8 million vehicles worldwide. The Toyota production system helped avoid major chip and logistics delays during the COVID time particularly. And they have deployed 1.1 trillion Japanese yen, and about 600 billion more is planned from the $1.7 trillion yen supplier fund that they're doing to help suppliers through loans and other help. Now, number 3 is EV expansion targets 1 million BEVs by 2027. BEVs were 2% of sales, only 200,000 in 2024. For comparison, Tesla sold 1.8 million units, far ahead of Toyota's BEV pace. Now, there's 15 new BEV models in the pipeline, and they've got new EV plants. And as I mentioned, that solid-state launch is planned for 2027. I would say it probably is not going to hit until 2028, maybe even 29. Let's see. The point with Toyota is they refused to go all EV. They wanted to go in a few different directions, but in particular rely on hybrids. And number 4 is China remains strategic. So China's sales for Toyota fell 1.6% in 2024. And competition is just growing intensely in China. And BEVs are now 25% of Chinese vehicle market. And Tencent partnership enhances software for the 2026 EV models. So it's a partnership between Toyota and Tencent. And the Shanghai plant opens in 2026, targeting about 100,000 Lexus BEVs by 2027. Now, here is the output on multiples coming from my valuation. And I'm going to circle a couple things here. So first thing is the stock is cheap on a PE basis at about 8 times, 9 times, and about 1 times price to book, meaning there's no there is no value beyond the historical value of the assets. Yet ROE is 12%, which is very respectful. But the point is that Toyota's cheap by valuation points, and I think from a valuation masterclass perspective, I don't think there's a lot of value for my students to talk about their PE. I would rather them have free cash flow, do free cash flow, and look at it. So let's look at the free cash flow outputs of my students. Here we can see in the upper left-hand corner the cost of equity of 9.8, the weighted average cost of capital of 5.3, and then what we can see is they come up with a target price, or not a target price, but let's say a value of 8,425 for the free cash flow, and that's this section. And students all presented this in their final presentations, but let's just look at what I'm talking about here. Right now I'm talking about 8,425 and then 10,942. Let's continue on and look at the next student. Here we can see the first one was 9.8 in cost of equity. Now it's gone down. And the cost of capital is an incredibly low 4.4, which I would say is probably a mistake in this case. Let's look at another one. Here we can see a cost of equity of 11% and a weighted average cost of capital of 5.7. Now, one of the things that seems a bit unrealistic here is that debt as a percent of total capital is more than equity. Generally, the banks aren't going to allow you to exist in that situation, but this is being caused because the price to book value is at 1, and so being depressed, it's bringing down that equity market value. And when we calculate weighted average cost of capital, we look at the equity market value. And here we can see another student talking about a 14% cost of equity and an 8% weighted average cost of capital. That's almost double the weighted average cost of capital of the other student. And you can see that free cash flow value comes down closer to the price, which is the blue line, to 3,254. And here we can see one more, and we can see roughly the same. So here's my free cash flow estimates, and the key thing that I'm looking at is trying to understand this particular line right here. Free cash flow to the firm is what I'm looking at, and the free cash flow to the firm, as you can see, goes from about 3,752 up to 5,812. And that's with still a pretty large amount of capex. If you see the capex line, capex is 3 to 4 trillion yen. So I would say that my forecast there is realistic for free cash flow. So I opened up my model and I went through it to kind of check what the students had done. And here comes my free cash flow valuation. I'm using an 11.8% cost of equity. I think that you don't want to go too low on cost of equity. That also would bring down your cost of capital unrealistically low. And so I've come to a 7.8% weighted average cost of capital. And then the present value of the future cash flows comes up to about 95 trillion yen. And then you can see my value comes out to 5,960. So what you can see from this is the free cash flow value of the company is much higher than the current price. That's why I was saying at the beginning, like, when is cheap enough? Now, on a P and price to book basis, I would say Toyota doesn't look that particularly super cheap. But here you can see it does look super cheap. Now, I just wanted to run through the 8 students' assumptions, and I've ranked them basically by the free cash flow value from the highest, which is 8,425, to the lowest, which is 3,254. And then you can see mine and my assumptions at this point. It's an interesting exercise because what you see and what I tell the students is that plug in the numbers that you think make sense. But of course, it's their first time doing it. So how can they know exactly what to plug in? How would someone know, particularly like in this case, that a weighted average cost of capital of 4% would be causing an extremely high value to the company, right? And so that's one of the things. Now, in the Valuation Masterclass, I teach the students about sensitivity, and this is where we can play around, and I'm looking at 4 different factors here, but let's just look at gross margin here. And this is a good one to see if gross margin falls from 19 to 17. That's a pretty big fall. And we can see that the target or the value I have in 5960 falls to 5571. So it's not particularly sensitive to that. That was an interesting one. Now, another one is, let's just say that I'm too... let's just say that's a good one. Now, my base case for terminal growth is 1%. If it was 2%, then the value of the company would have gone up to 6658 versus 5960. So now I use my world-class benchmarking scorecard to measure if a company has a competitive advantage, and I developed this scorecard 10 years ago. And my team gathers the yearly and quarterly financial data of 26,000 companies worldwide, and then we calculate each company's profitable growth score, which is a composite measure of both profitability and growth. Now, after that, we rank the company relative to sector peers of a similar size, and a decile ranking of 1 or 2 is financially world-class, while 10 is worse. And then we assess the company's performance over the prior 4 years and the past 12 months, which we call PTM. PTM, of course, is most important because that's most recent. So is the company financially world-class? The answer to that is no. Toyota is an average company when it comes to a combination of profitability and growth. The thing that's holding Toyota back is that it has a lot of assets on its balance sheet, and that definitely is a drag. And here we can see the share price from Yahoo, which has gone all the way up in 2024, up to almost 4,000, and now it's down at about 2,500 or so. Now, I use my FEMR methodology to determine the attractiveness of the company. I look at fundamentals, valuation, momentum, and risk. And here we can see that the scoring of the company relative to 2,180 non-financial companies in Japan is very low. And it's low due to a low asset turnover and a high leverage and a recent high beta. So from an attractiveness perspective, my model is telling me it's not a buy at this point, even though it is relatively cheap. And then here you can see my global stock tracker where I'm looking at Toyota right here. And what you can see is that it has a net profit margin that's beaten only by Ferrari. And net profit is 11% for Toyota. It's unheard of. And return on assets is about 6%, which is, more reasonable. But that's also because there's a lot of assets, on the balance sheet, as I mentioned before. So if you want to build up some strength in your valuation techniques like my students that we had in Team Toyota, just join us at valuationmasterclass.com and join the next Valuation Masterclass Bootcamp 21 at the end of May. I'll see you there.